future. We're talking real money.
Another week, another dollar, or another dollar to talk about, or many dollars to talk about, but we're here to talk about money, that's for sure. And this is the Q&A edition of Talking Real Money that pops up pretty much every Friday, as long as we've got questions that come in to us at talkingrealmoney.com on that contact form. And there's a cool little button there on the left-hand side down at the bottom where you can record your questions using your computer microphone or the microphone on the bottom of your phone too. You can even do it that way, but without the phone call. Usually sounds better than the crappy cell phone calls because they're so badly compressed. So we love taking calls, questions that way. You can also type your questions if you want, but the voiced ones, they end up in the Friday podcast. So thank you for being there. Thanks for listening. And let's get started with today's very first fascinating question.
Hello, Don. I've got a question for you. Everyone talks about stocks and their performance during the 1930s Depression. But how did U.S. government and corporate bonds hold up during the Depression?
Actually, that is a really good question because it goes right to the heart of our philosophy, our investing philosophy, which is you own bonds primarily to act as a longer-term hedge against the ravages of particularly bad markets. And the Great Depression was about as particularly bad as a market could get. As a matter of fact, if you didn't reinvest dividends or calculate even in dividends, it would have taken you a very long time to get back to 1929 prices. It was 30 plus years. Or 30 years, about 30 years. But with the dividends, because there were a lot of dividends with stocks then, the stock market did recover reasonably quickly, over a few years. However, bonds did incredibly well. And that's because bond prices they don't tend to, they do. Bond prices rise when interest rates fall. And in the Depression, we hit a recessionary period, and that's kind of what depressions cause. And in a recession, interest rates, demand for money goes down, so interest rates decline. And in that case, bonds went up, and the numbers are pretty impressive. Corporate bonds went up an average of about 7% per year. Treasuries went up about 4% per year, if I remember. Yeah, that's about right. The overall average of all the bonds was right around in that 10-year period from 1929, beginning of 1930 to the beginning of 1940. Overall, bonds returned about 6% per year, which was way better than the stock market, which was basically, for all intents and purposes, a loser. So bonds did well. Thanks for that great question. I appreciate it. Again, send your questions into talkingrealmoney.com on the contact form, and here's our next one.
Hello, my name is Jim. I'm from Michigan. My wife and I are in our early 60s, both retired, and we have pension income that we supplement with deductions from our traditional IRA. We'd like to convert money each year up to the next tax threshold to a Roth IRA, but we don't have money outside of the traditional IRA to pay the taxes on that conversion. What are the pros and cons of using tax money as opposed to, using the traditional IRA money to pay the taxes as opposed to trying to find another way to do it? Thanks.
Well, given the fact that knowing the specific numbers might help a little, but I don't think they're going to help much. I played with a lot of hypothetical situations, and without having a pool of money from which to pay the taxes, the benefit is already going to be negligible, and in your case, even more negligible, since your tax bracket is your tax bracket unless brackets change. So we can't play I expect my tax bracket to be higher in the future game, which even then, without a pool of money from which to pay it, that doesn't reduce the amount of money in the IRA. You already hurt the IRA because you're going to have to pay taxes on the money coming out of the IRA with money from the IRA, which means it's not money that's going to be earning tax-free, which negates the benefit. So in your case, I'd probably just keep doing what I'm doing, and that is taking the income from the IRA since you need that to live on. Thank you very much for the call, for the question. And remember, talkingrealmoney.com is the place to go. You just go to the contact form, and then you can send in your question. Let's go to the next one.
Hi, guys. This is Bill in Texas. Thank you for your show. You frequently recommend that people wait until the age of 70 to claim Social Security, and I understand why. But when I go to SSA.gov and look at my actual benefit amounts at different claiming ages, if I were to claim at age 62 and invest every penny of the benefit in a diversified portfolio of low-cost ETFs, and if I could get 5% annual return on that money, I would be better off claiming at 62 as opposed to 70, all the way up to age 90. And the reason, of course, is the benefit amount and the compounded growth on that benefit that I would claim between the ages of 62 and 70. Additionally, by claiming at 62, I provide myself some protection against an early death or some type of change in the Social Security program like means testing that might limit my benefit in the future years. So given that, and given the fact that according to my calculations, 5% growth would make it advantageous to claim at age 62, why wouldn't I do that? I look forward to your response. Thank you, guys.
Well, here's another situation where exact numbers would help, but I ran some hypotheticals based on Social Security tables. And a couple of things I don't think you took into account. One is, at age 62, when you start taking that money out, unless you have almost no income, the Social Security is going to be taxed. So I calculated it on having 85% of the Social Security taxed at 20%, and I could not possibly get even close in any scenario buying an annuity at age 70, because that's the way I calculated it. It's you take the money for the 8 years, the Social Security, the reduced benefit for 8 years. You invest it at 5%. You add that monthly amount the whole time, every year for the full 8 years. Then at the end of 8 years, you take what's left and you pay the taxes on that, because there will be taxes on that. You probably paid some along the way, but you will probably pay some at the end too. So you're going to get taxed on the returns over that time, which reduces the amount you're going to have when you finally invest that in the annuity. Now, based on today's annuities, I could not get anywhere near the benefit at 70 years old. I think the closest I got was a difference of about, and that was assuming very low taxes, I think the difference was like $300 a month at 5%. The other problem is to get 5% consistently, typically, this is not typical, but typically requires taking a little bit of risk, which means that number can fluctuate. So when we're talking about waiting to take Social Security until 70, we're talking about a riskless 8% return. And riskless is hard to come by. Yeah, I know you can today do it with CDs. So I guess if you built an 8-year ladder, you'd be in the 4% range, but you're still going to come in hundreds of dollars below the amount you'd get at age 70. According to all the calculations I ran, which again account for tax situations and 5% or less growth. So I don't see it happening. But of course, if it's always your call, and if you can take more risk, well, it might work out. It might. But it's just the certainty of waiting. I mean, I can tell you personally, having crunched lots of numbers, I could be taking my FRA right now, but I'm waiting because I'm confident I'm going to get a lot more money. Again, personal call, but I don't see the numbers working out. Thank you very much for your question. And now, dear friends, we move on to the final question of the day.
Hi, gentlemen. First, thank you for your podcast, your radio show. I started listening a few months ago and have learned a lot. It's been very helpful. I have 3 questions, one on behalf of my mother, one for myself, and one more general. My mother is turning 70 in December. She'll be retiring that month and begin to collect her Social Security. At that point, she's in pretty good shape for retirement. One account she has is an employer-provided employee contribution account tied to her state pension, from which she can either take a lump sum or monthly disbursements or some combination. She'd like to take a lump sum of about $100,000 out of $300,000 total to pay off a HELOC and a mortgage she has on her house, mostly for peace of mind to not have debt in retirement, but also because the larger loan is adjustable rate and has crept up to the point that she probably won't make much more, if anything, in investments. If she takes out the lump sum of $100,000 out of this, which she's allowed to do, question is how much taxes? Is it just the 20% on any interest, capital gains over what she put in, or is there something else she might have to be concerned about there?
Well, it looks like that last question is actually 3 last questions. So let's break them down into 3 parts. Let's start with Mom. Okay, you can take a lump sum from a retirement plan and then roll that over into an IRA and continue to make money on it tax deferred until you take it out eventually. If she takes a lump sum out, though, to pay bills like the HELOC and the mortgage, then she'll be taxed on it, and it will be at her ordinary income bracket, whatever that might be. So you'll have to sit down and figure that out, which means that if it's 20%, for example, then if she takes out $100,000, pays $20,000 to the government, has $80,000 left to pay down the notes. Now, I would suggest, the HELOC with its adjustable rate, absolutely pay that off. But unless the peace of mind is incredibly important to her, important enough to allow thousands of dollars to stop earning money, then I would probably only pay off the HELOC and let the mortgage run, and then either take the pension if that makes her more comfortable, if that's a higher level of security for her, or take the lump sum and put that into an IRA and get it invested. So I think I'd split the difference there. Now on to question number 2.
Second question for myself is I have a general brokerage account, a Roth IRA, and was able to sit down with an Appella advisor earlier this year and sort through my hodgepodge, which has been very helpful. But one thing I didn't think to ask was, where should I keep which assets? So I have about a dozen ETFs now, and I guess, does it make a difference if certain asset classes or certain types of ETFs are kept in which account? Should certain things be in Roth versus general brokerage? For example, should small cap be one place, large another, international versus U.S., bonds one place, REITs another? Or does it matter? Should each account just have mirror each other with the same dozen ETFs in each account? And if I open a traditional IRA, should it be the same? So that's, I guess, a question of where to put investments.
I'm glad you found the meeting worthwhile. I hope others find it worthwhile. We really do try to help for free at Appella. Now, as far as placement between your brokerage and your Roth is the place where stuff that gets taxed should be placed. So your portfolio is going to have, part of it is going to be overweighted, but the whole thing, between the 2 accounts, it's going to be properly weighted. So your ETFs, for example, your more growth-oriented ETFs, the ones that pay less in the way of dividends or are dividend-free or close to dividend-free, those should go in your regular brokerage account. Those that pay higher dividends or your income-generating accounts, investments, like a real estate ETF or something, or a real estate fund, those should go into the Roth so that they are totally protected from all of those taxes. And with an income-oriented fund, that can be pretty ponderous. So that's how they should be split. They should not be just divided equally between them, because you want to take advantage of the tax-free nature of the Roth. And the best way to do that is to put the highest ongoing tax stuff over there. The other thing you need to remember is that in your regular account, if you have an ETF that pays little or no dividends along the way, when you take the money out at the end, it's only taxed at a capital gains rate, not as ordinary income, and that means it'll be taxed at a substantially lower rate. Now, we get to your final question.
And then the last question, more generally, I've heard you mention on the podcast a couple times, I think, that investing in real estate only beats inflation by a fraction of a percent. And I don't understand that, because just looking around, it seems house prices, house values have beat out inflation by a factor of 4 to 1, 5 to 1, 6 to 1, depending on where you are in the last 40 years, even the last 20 years, more than double, about 230% of inflation nationally, and much higher in some places. A lot of places I've looked recently, houses have gone up 50% just since the pandemic started, and combining that with higher interest rates makes it even more unlikely to buy a house for a lot of people. So I'm wondering what I misunderstood or what I misheard, if you could just clarify when you say that real estate has only beat inflation by a fraction of a percent, as opposed to what it appears to be, 300, 400, 500% faster than inflation in terms of value growth. Thank you, and thanks again for everything you guys are doing. Appreciate it.
In some markets, it does appear that real estate is increasing at double-digit clips. In some markets. However, there are other markets, ones that you may not pay much attention to. I'll throw in some of the Rust Belt markets like Detroit, where real estate prices over the last 2 decades have declined. So when you put all of them together, the average return over the past 20 years, and this is from a couple of different sources, has been around 4% per year. One had it at 3.97, I think, another one at 4.5, but it's roughly around 4 for the last 20 years. Remember, in that period, we had a run-up in the early part of that period. Then we had a dramatic decline in most of the country. Then we had a gradual run-up, but that run-up was focused in a few areas. Florida, the Northwest, some of the Northeast, coastal areas, Texas to some extent, Arizona to some extent. But the Midwest got left out. I've looked at prices for decades in some of the softer parts of the country, and they haven't budged. So what you're looking at is anecdotal or just regional. And the overall numbers for real estate for homes, should have said at the beginning, single-family homes, have not been particularly impressive. One of the big reasons why our gains feel so good is because our real estate, our homes, are heavily leveraged. So we don't have a lot of skin in the game, and when we do get a profit, it looks good. But remember, those people in 2008 who had a lot of leverage on their real estate lost everything. I know, and again, that's anecdotal, but I know a number of people who lost everything, who filed for bankruptcy because of real estate investments in 2006, 2007, that killed them. When prices go down, leverage amplifies that too. So, big moves in some areas, but again, it's not national. According to Case-Shiller, which has looked at real estate prices going back over 100 years, the average return over a century, which is great data, has been below 2% per year after inflation. So that puts us probably at about 4 or 5% per year, which seems like a reasonable number when you're averaging that out over the whole gigantic pool of real estate in the whole country. And you've had some great periods and some lousy periods. But overall, houses have not done as well as the stock market. Now, let's flip that. If you bought commercial real estate, the commercial real estate in the last couple of decades has slightly outperformed the stock market over a few decades. There are times when it does better, times when it does worse. And that's because it's a riskier investment, too. And the other thing about homes is they're homes. They're not supposed to really be investments unless it's your business. And if it's your business, then you have a lot of ways at your disposal to improve your return on investment by running it as a business. But just passively investing in homes hasn't nationally been a very great investment. It hasn't been awful, just hasn't been great. Thank you for all of your questions. Thank you all for all of your questions. If you have questions, go to talkingrealmoney.com and send all of them in or speak them in. And you can also call us at 855-935-TALK, 855-935-8255. And by the way, if you want to talk with us, with Tom and myself, call us on Saturdays. We're together on the radio in the Seattle area on Saturday from noon until 2 Pacific time, 3 to 5 Eastern time at 855-935-TALK, 855-935-TALK or 8255. And when you call, we will talk. We will have a conversation. We usually don't get to the calls until about 15 minutes after the hour because we usually talk about something to begin. There's news on the station. So if you called at 3:15 Eastern time, perfect. 4:15 Eastern time, perfect. 4:30, whatever. Thank you so much for being a part of this. And if, like our last questioner there, you do need a little help with your hodgepodge mess, we will help you for free. We will help you with no obligation or pressure to become a client because we don't need to pressure you. We get a lot of clients just from one thing and one thing only, and that is being honest. We just tell the truth. Yeah, plus, we help people, anybody who needs help. So just go to talkingrealmoney.com, click Meet an Advisor, and thank you for being there. I do appreciate you very much. I'm Don McDonald, once again, Talking Real Money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.